how can USDC or these different exchanges offer such nice interest rates when banks are giving 0.0, or now they're giving 0.5, but how can they offer, interest rates from 4% to 12% or 10%?
Yeah.
That's the first question that you have to answer for my brother.
Yeah. So
I know that there's different, I know there's circle yield. So if you're an institutional client or thing, you can go to circle yield, which, as you said in several interviews, it's over collateralized and you should be protected, but we'll get to that one. I just wanted to know, like, some of these places are 10%, 9%, Voyager, BlockFi, Nexo, Genesis, etc.
Sure. Yeah. I mean, look, so if you think about it, you have a kind of base layer, which is the sort of digital cash equivalent of USDC. And that is this, always redeemable for $1. And it's a regulated, digital cash instrument that exists. And it's very easy to exchange, right? With point to point, as your friends or others that you've talked to, really, really straightforward to send it, receive it, use it. And it's become very, very popular as a digital currency to use in trading, investing, international payments, other things. And so as its utility has grown, and as more and more people and firms want to use it as a form of working capital, as a new kind of electronic stored value working capital mechanism, there's higher and higher demand for people who want to borrow it. And so one of the really powerful things about blockchains is not only do they allow these fast transactions to happen, but you can actually build, essentially, borrowing and lending models on top of it. And so there's grown over the past, in particular, the past several years, last 2 to 3 years, large, both centralized, what are often called CeFi lending markets, and what are called DeFi lending markets, where the market of borrowers and lenders is convened by a piece of software on the internet. So you're not dealing with a company, you're just dealing with a protocol. But nonetheless, you have essentially interest rate markets of borrowers and lenders. And the demand to borrow USDC is high. And the interest rate that borrowers are willing to pay is high. And that is the source of those yields. Basically, you have borrowers, and to put it fairly simply, the other side of that borrowing, and I'll use circle yield as an example because it's the one I understand probably the most. You lend us USDC, and we lend it wholesale to institutional borrowers. So these are, in fact, hedge funds, family offices, systemic trading firms, electronic markets firms, or other major firms in the ecosystem that want to operate using USDC. And these are firms that are borrowing at a high interest rate, but who are generating returns north of that. So, an 8% interest rate, to borrow at an 8% interest rate or borrow at a 10% interest rate, that's not unheard of in a lot of things. Our credit cards are 20% interest rates or 17% interest rates. Venture debt, which is what startups borrow, typically have interest rates of 10, 12, 13, 14% on them. Interest rates in securities lending markets, which is the interest rates that say an institutional fund would pay to borrow against their stock, can be fairly high. Now, corporate debt that's underwritten, where a corporation's borrowing against their balance sheet and their P&L, that's underwritten by an investment bank and has a coupon and a rating and so on, that tends to be a lower interest rate kind of debt product, right? But generally, when you look at interest rates that people borrow at, they vary from low single digits to high double digits or higher. And so what you have in USDC is you have a borrowing and lending markets that exist at the retail and institutional level, and those are floating right now. So on DeFi right now, you can borrow USDC, I think for like 3%. So the interest rate markets adapt to kind of market conditions and demand.
Yep, and you could you could borrow, but then you can earn interest at a longer term. You can lock in 6 months, 12 months. Right.
That's right. That's right.
How can they lock that in if they don't know if the borrower is the borrower borrowing short term, or are they borrowing a long term when you lock in for 12 months on Circle Yield I'm referring to?
Yeah. So with Circle Yield, if you want to effectively lend for 6 months and get a fixed rate and a fixed return over that time, that's exactly right. That capital is then being utilized downstream by borrowers for longer periods of time.
Okay.
So they have effectively, oftentimes they'll have like the equivalent of like an open credit facility that they're utilizing in their own business, and that credit facility has a term on it and a time frame on it and the like.